Hello, welcome back to Retirement Clarity Radio. My name is Scott Newhouse. I'm so glad that you are with me as we continue on our journey of exploring how do we generate a retirement income that's going to last you for the rest of your retirement. We've also phrased it, how do we create this retirement paycheck that we need to create since we're going away from that earned income that we're used to for 2 to 3 decades, and we're transitioning into creating a retirement paycheck on our own that's hopefully going to last us at least 2 decades, maybe 3 decades, maybe even 4 decades, considering how long people are living these days. So today's the last episode in this series, at least for now. And then if we get enough feedback in terms of what else we want to talk about in terms of creating a retirement income, then we will absolutely revisit this. But today's episode, the last topic we're going to cover is annuities, and we're kind of going to go over Annuities 101, the basics, the most common types of annuities that you might see out there, as well as some pros and cons of using them as an income stream in retirement. So let's just jump right into it. Before we do that, though, I have to state that this episode on annuities is going to be general in nature, and we cannot and will not cover every single detail of them. The reason for that is because they're simply too complex to cover everything in one episode. I'm also not recommending them, and I'm also not saying you should avoid them completely. What I think you should do after you listen to this episode, of course, is if you are still interested in them, I think you should speak with an independent, objective, financial or insurance professional who would not receive a commission from any sale to discuss whether one of these products is right for you or not. So I think that's the best route to go if you want to consider an annuity in your retirement. But of course, you got to listen to this episode first. So with that out of the way, the first question we want to ask and answer is, what is an annuity? So an annuity is simply a contract that you enter into with an insurance company. So you're going to pay that insurance company via a lump sum or through a series of payments, and in turn you're going to get regular disbursements at a certain point in time, which you can control the timing of that depending on the type of annuity that you buy. And the timing of that is known as either an immediate annuity, which pays you out immediately, as the name says, or a deferred annuity. So you pay them and then you defer your disbursements, your payments, until a set period of time, which you would obviously figure out in terms of what kind of annuity you buy and when that timing would be. You can buy an annuity within your retirement accounts, or you could buy them outside of them in a taxable account. Also, you will receive payments from the annuity depending on the policy. So some annuities offer payments for a fixed period of time, like 10 or 20 or 30 years, while others offer payments for the length of your life. And so it's just going to pay you out until you pass away. There are other types of annuities that we're going through a lot here, but there's other types of annuities that make payments to married couples for as long as one of the spouses is alive, and that's called a joint and survivor annuity. So as you can tell, there are a lot of variables here, and these variables are going to depend on the type of policy that you're considering purchasing. So we can just go so many different ways, but that's kind of an overview of the options that you have in terms of the features that an annuity might have. Now, let's go into the 3 most common types of annuities, and they are a fixed annuity, a variable annuity, and a fixed indexed annuity. And they all operate in slightly different ways, and actually some ways they're quite different. So let's just jump right into the first one, which is a fixed annuity. So these annuities pay you a guaranteed rate of interest, and they're generally attractive to people who are more conservative with their money and would rather have a guaranteed amount. And I use that, kind of in parentheses because there's the disclaimer with the whole guarantees with annuities. But they're for people who would rather have a guaranteed amount coming back from the money rather than the potential of a higher but not guaranteed return. And so let's talk about what these guarantees look like. So an annuity guarantee is offered by the insurance company where they say, we will give you a guaranteed rate of return on your product, like that fixed annuity that we talked about before. However, it is not a guarantee that the insurance company will, for the length of your lifetime, remain solvent and have the money to pay all of their claims. So what you want to do here is you just want to make sure the insurance company that you purchase from is in good financial health, because God forbid they go out of business, what happens to your insurance policy proceeds from there? Now, the government does have, some kind of backup in terms of reclaiming annuity amounts from failed insurance companies, and that changes. So I don't want to get into specifics of that right now, but that is a guarantee that either the state government or the federal government will back up. But you got to make sure that the insurance company's in good financial health, because you don't want to put yourself at risk of needing to file an insurance claim on the insurance company that you made the annuity product from. Okay, so we've got that big disclaimer out of the way in terms of the guarantees. So let's keep on the conversation with the fixed annuity. When you purchase a fixed annuity, you can start receiving the annuity payment either immediately, or you can opt for a deferred disbursement. So again, that's going to be your choice depending on the policy. Now, while there are some differences, a fixed annuity is really similar in a lot of ways to a CD, which also offers you a fixed rate of return. And so let's kind of put this into practical terms, because I know, this might be a little bit confusing, especially if this is the first time you're hearing about annuities. So again, a fixed annuity, let's just do an example. Based on data from Schwab's income annuity estimator, a 65-year-old man could currently expect to receive monthly payments of about $481 per month in exchange for purchasing a $100,000 annuity. And so if we just do that math really quickly, 481 times 12 is $5,772 per year by purchasing that annuity of $100,000. And so that's and that payment would be the same throughout the course of your life. So $481 per month for life. And again, that's on a fixed annuity that we got from Schwab's income annuity estimator. You can search that on Google or whatever you use to get the annuity estimator on your own and see more details on that. Okay, so that's the first and I think the simplest type of annuity, which is our fixed annuity. Let's go on to the second one, which is a variable annuity. Now, in a variable annuity, you choose a mutual fund to invest in, and the value of your annuity is going to depend on the performance of the mutual fund that you select. So unlike the fixed annuity, which offers that quote-unquote guaranteed rate of return, your variable annuity does not have a guaranteed rate of return, as it's dependent on the mutual funds that you choose and their performance. It is possible, though, to purchase something called a rider, which is an addition to the normal policy, so that you can guarantee an income stream regardless of the performance in the case that your mutual fund does poorly. In addition to that, variable annuities can have quite high fees, and so you want to make sure you know the total cost before you purchase anything. Some typical expenses include account fees, investment fees, mortality fees, rider fees, and potentially even more. Now, these are required to be disclosed on the contract, so you got to make sure that you understand them before you purchase them. However, if you've seen long contracts before, that's what these annuity contracts are like. Lots of documents, and sometimes the fees can get hidden in there, which again goes back to my point originally, which is if you're considering this annuity in retirement, any types of annuity, you've got to talk to an independent, objective financial or insurance professional who can give you some guidance on what to reasonably expect in terms of the policy pros and cons, as well as the fees, because especially these variable annuities, they have a lot of fees embedded in them, and you just got to understand so you can make an informed decision whether you want to go for it or not. That's obviously up to you, and I can't tell you on this podcast, but I want to make sure you understand the fees associated with any of these policies. Last thing about variable annuities is that you can have an immediate variable annuity or a deferred variable annuity. So you can do it either way. You can get that disbursement, that payment right away, or you can get it down the road at a certain point. That's up to you in whatever you choose in terms of your policy. The last most common type of annuity is a fixed indexed annuity. So The indexed annuity is, in my mind, much more complicated than the previous two types mentioned. So this indexed annuity you purchase has its value tied to a specific stock market index, like, for example, the S&P 500. However, you do not technically own shares in the S&P 500 index. Rather, your annuity value earns a percentage of whatever gain the index has earned. This is something called the participation rate. For instance, if the index you choose earns 10% in a year and your participation rate is 80%, then your annuity will be credited with an 8% return. So do we see how that works? The S&P 500 is up 10% in a year, but your fixed indexed annuity contract says you're only going to get a participation rate of 80%, and so 80% of 10% is of course 8%, and that's the most that your annuity will go up. However, there also might be something called a cap rate. And what this does is it limits the return that can be credited to your account. So if a contract has a 7% cap rate and the index tied to that contract earns 10%, then the maximum your account will be credited is 7%, even though the index earned more than that. So again, the cap rate is going to be the maximum amount that your annuity contract can go up in a given year, and it's going to be capped out at that rate. And so you gotta, if you're looking into these fixed index annuities, which are really complex, you gotta see what that cap rate is and see the maximum amount that it can go up. Now, you might be wondering, Scott, why in the world would I want to invest in something that's going to limit the returns I can get and it's going to cap out the returns I can get? Well, because on the other end of the spectrum, if your index that's tied to your contract loses value, then your principal will stay the same. So if your index is down 10%, the S&P 500 is down 10% and it's tied to this contract, then your annuity value will stay even. It's going to stay flat even though the index is down 10%. So these annuities offer downside protection that a lot of people find attractive, even in, especially in retirement. They don't want to, see that principal loss, and so that's a big selling point for these fixed indexed annuities. These annuities also might, depending on the contract, offer some type of minimum guarantee return, although some policies don't offer that at all. Again, it's just so dependent on the specific contract. And then lastly, when it comes time to start receiving the annuity, you can generally choose to receive lifetime payments, or you can choose to make discretionary income withdrawals, at whatever point in time that you want to make them. The amount you receive on each of these options depends on the value of the annuity at the time you start making those distributions. And lastly, and this is the last one, as I said before in the variable annuities, you really got to watch out for all of the fees that are included, because these contracts are so complex and they can get quite costly in terms of the fees because the insurance company thinks that you're paying for all these benefits that they offer. So there's just a lot of fees embedded within it. You got to make sure you understand all of that before you sign on the dotted line. Now, it's really important to remember that these annuities are complex, and we have not discussed all of the details in this episode. Also, some annuities may have very high sales commissions for the agent who sells it to you. And then lastly, some annuities might have something called a surrender period, i.e. you can't get out of it for 5 to 10 years without paying a surrender charge. And those charges depend on the policy, but they can be steep, and of course they lower the value of your account. So there's just so much in terms of annuities that, as I've said before, I'll keep saying again, if you want to consider any of these types of annuities in retirement, the fixed annuity, which is the most simple, a variable annuity, which is more complex and has some pros and some cons, and then the fixed index annuity, which is the most complex, but it offers you that kind of quote-unquote downside protection. You really need to speak with someone who is not going to receive a commission from the sale of the product, just so you can know that they're disincentivized from kind of fudging over the details. You got to make sure you understand all of those details. So speak to someone who's objective and independent to make sure it's truly in your best interest to purchase one of these. So that's kind of the high level 101 of the three most common types of annuities. Now I just want to briefly talk about a few pros and some cons of annuities, and then we'll wrap up and get on with the rest of our day. So let's start out with the pros of annuities. And this won't apply to all three of those types of annuities that we talked about, but they can apply to one or two of them. Because again, all of those three have so many different features. They're not all going to feature the same things, and they're not all going to have the same negatives to it as well. So some pros of annuities. The first one is it gives you a reliable, stable income stream. So for a product like a fixed annuity, you're going to know exactly what dollar amount you're going to receive in monthly income. And as we talked about in that example above when we talked about fixed annuities, that 65-year-old person who puts $100,000 into the fixed annuity, they're going to get a monthly payment of $481. And that's going to be able to be added into the quote-unquote stable income stream that they get from things like Social Security or a pension or any of those other stable type investments. And so that offers a lot of peace of mind for people in retirement who like that stable income coming in. The second benefit of annuities is that you can have lifelong income. So depending on how you structure your annuity and how you choose it, when you're choosing that policy, this income can last for the length of your life. And so that would obviously be another source of peace of mind and comfort, knowing that you're going to have let's go back to the example before. You're going to have that $481 added on to the pension and Social Security income for the rest of your life. The third pro of an annuity is that they are not at risk of market losses. And this is especially true of fixed annuities as well as fixed index annuities. You are not susceptible to the ups and downs of the stock market and worrying about what CNBC or Fox Business is saying about what's going on in the market on that specific day, because you have given that risk to the insurance company, and as a result they are giving you that fixed payment of some sort that you can depend on for the rest of your life. So you don't take those risks, the insurance company does, and then they give you that stable income, and you don't have to worry about the market losses as long as you structure it correctly in two of those types of annuities at least. The variable annuity, it's going to be a little bit different, but the fixed annuity and the fixed index annuity especially are not going to make you at risk for those market losses. Now, so those are three pros of buying an annuity in retirement. However, there are some significant cons that you really need to consider as well. The first one, in my mind, this is probably the biggest one, is the lack of inflation growth. So for some annuity products, the income they provide does not adjust for inflation, which means that the $1,000 a month you receive in annuity income in 2021 will still be $1,000 per month for the rest of your life. So, $1,000 in, let's just say, 2035 is not going to buy you nearly as much as $1,000 will buy you in 2021. And so you have to think about if there is an inflation adjustment for these annuity income streams. Oftentimes there is not, and you have to think about how is that going to affect your purchasing power later in your 70s, 80s, and 90s. And it's definitely going to put it's definitely not going to buy you as much as it will today. And so you have to think about if that's going to put a damper on your retirement lifestyle later on in life. The second con that I have for annuities is that they often have hefty and hidden fees. Now, I'm a capitalist. I want people to, make money, run profitable businesses. I'm running a profitable business myself. So I don't have anything against people making profits, but I do have a problem with kind of hiding these fees inside of complex and long contracts. So I don't like hidden fees, and you've got to watch out for if you're paying too much in terms of all of the fees in there. Annuity contracts can be quite complex, so you've got to see all of the fees and make a determination if it's actually worth it for you. The third con that I have is the lack of flexibility. Now, we discussed before something called surrender periods or a surrender charge. It essentially ties up your money in these annuities for certain periods of time, and you can't withdraw or get the money out. And then in addition to that surrender charge, for certain products, you are actually locked into that contract and that product for life. So you can't get your money back out. So overall, with an annuity product, you are simply going to have less flexibility than you ever would with the traditional investments in a stock and bond portfolio, buying, low cost, well diversified mutual and ETF funds. The fourth con that I have is that your returns could be lower than market returns with these annuities. Since you are paying this insurance company to give you this stable income stream, you are giving up the chance to earn market returns with your money, which means that you could be giving up much higher potential returns by putting this money into the annuity and getting that stable income, as opposed to investing in that traditional stock and bond portfolio and getting potentially higher returns. And so that's another downside you need to consider. The last one I have for you today is your beneficiaries may not receive anything at your death. And again, as I've said before, this depends on the type of contract and the type of annuity that you pick. Some annuities do allow you to name beneficiaries, and they can receive some kind of inheritance at your passing from the annuity. However, there are a lot of annuity contracts that simply end at your life. So when you die, whether that's 2 years after you buy the contract, 5 years after you buy the contract, or 30 years after you buy the contract, your beneficiaries will not receive anything. And so, wow, we have really gone over a whole lot. This episode's a little bit longer than I like to do, but we just had so much to cover today. We've covered the three main types of annuities. We've talked about their pros and cons. I think there are a lot of cons here, but for a certain type of person who really values that stable income in retirement, I think some annuities can make sense. I'm hesitant about them, especially because of those 5 cons that I mentioned just now. If you are still on the fence about purchasing annuity, please do yourself and your family a favor and go talk to an independent financial or insurance professional so that you can make the best decision for yourself and your family. Now, last thing before we go, if you want to learn more about everything that you need to do to ensure a confident and comfortable retirement, I really encourage you to go check out my books at freeretirementbooks.com. I've written books on a variety of issues, including Social Security, Medicare, taxes, and 65 questions you should ask yourself before you retire. They're all very helpful and they are free. Again, just go to freeretirementbooks.com, and I think that'll be helping you get in the direction that you want to go to in your retirement. So that's all we've got for this week. Thank you so much for joining me, and we'll see you next time. Bye. Thanks again for listening. As a reminder, you should consult with a financial advisor familiar with the specific circumstances of your unique financial situation before making any financial decisions. Nothing in this podcast is a solicitation for the sale or purchase of any securities. Any mentions of rate of return are hypothetical in nature and not a guarantee of future returns. Scott Newhouse, CFP, is an investment advisor representative of Forthright Finances, a California and Nevada registered investment advisor.